Well, hello and welcome to Switzer Investing TV. I'm Peter Switzer, our first show for 2025. Thanks for joining us. And it's going to be an interesting year. At this point in time, someone like Shane Oliver from AMP, and Shane is the chief economist there, but he's also a chief investment strategist. And he thinks the stocks will go up this year, but he wouldn't be surprised if there was a 15% correction. Could be a bit on the high side, but it's highly possible. The US market in particular has really rocketed over the last 2 years, while our market has done pretty well, but hasn't rocketed. So there's always a possibility, particularly with the new president, namely Donald J. Trump, that anything could happen, and that could ultimately cause a curveball, though I do think Donald Trump sees it as important that Wall Street likes him. And so I think we would get very careful about over spooking the market. I think there's a lot of potential for stocks to go up because interest rates will be coming down, particularly here in Australia, and that should help a lot of local companies. And we'll be talking about the kind of companies that might benefit from lower interest rates later in the show with Junbei Liu. Joining us on the show is, of course, Junbei Liu of Tribeca Alpha Plus and the MD of Bentham Asset Management, Richard Quinn. This is one of the best bond fund managers in the country. Got a very good reputation, done really, really well. And 2025 is expected to be a good year for bonds. So it's been a good get for me to get Richard on the program to talk about his outlook for bonds for 2025. That's coming up. But now start with the wonderful Junbei Liu of Tribeca Alpha Plus. Well, thanks for joining us, Junbei Liu.
Thank you for having me, Peter.
First year back.
That's right. Happy New Year.
Yeah, Happy New Year. And will it be a Happy New Year for investors, do you think?
I think absolutely. I think everything looks
great. I'm
surprised
you would say absolutely.
Absolutely. It's looking great. So, You know what don't you like? We think our economy is holding up okay, a little bit tough for consumer, but the rate cut is coming. Right now, most of the economists think it's February. If not, it's May. So, it's coming. It'll help us to alleviate some issues. China, their GDP number just came out.
Yeah.
Incredibly strong.
I was happy about that.
I know, but some of it might be a bit pulled forward because people worry about tariff and they try to sell all the products they can get out of China, right?
Yeah.
So there was a bit of...
We should explain that that's kind of Trump related as well.
Trump related,
because there would be American importers of stuff.
That's right.
Fearing that in 6 months' time there could be a 60% tariff on, so they've loaded up and bought lots of China's goods.
That's right. That's right. One of our company, Breville, actually has that kind of exposure, right? Make stuff in China and then ship it to America. Now the challenge is they just go, okay, let's just get as much product out as possible because we don't know what the tariff might look like, and then they need to diversify other base.
And Donald J. Trump can be hard to read.
Very hard to read. Inauguration, what is he going to say?
But you would have factored in that with the potential curveballs that comes from a Trump presidency, net, does he look like a plus for stocks rather than a negative?
I think he's a plus for stocks. I really think so. He's talking about deregulation for the banks, for the financials, and then the deregulation for small businesses. If you look at the consumer confidence, small business confidence improved enormously in the US, of course. And then he's also pro technology businesses, so that's in a way support that kind of reduce regulation again. So that's all pretty positive. Now people worry about their pro business or pro consumer stimulatory type of policy suddenly will drive inflation. But I think this fear is sort of unwarranted because Trump actually has appointed quite a lot of people in his administration that there will be checks and balances to help get through that.
And I think that Donald Trump loves to be loved by Wall Street. So if he comes up with a really crazy measure that knocks stocks for a 6, that doesn't seem like the kind of thing that Trump
doesn't
wants
sound
to do.
right. That's right. That's right. And also even the tariff that people worry about, all these tariff he might talk. Really how much of tariff he really will execute on them is I think it's a far way less bad than what people expect right now. China 65%, just very difficult to implement into something like that. I just think there's a lot more to play out on that front as well.
Yeah, and I think there are some pretty big American companies like Apple who would have been at least talking to Donald Trump saying, well, consider the implications on us as well. And I don't think they can bring all their stuff home and produce it in America, but that's out there. All right, so Do you worry about the magnitude of debt out there, particularly with the US?
Look, yeah, okay, there is a lot of debt,
Yeah.
but the good news is the interest rate is on the way down.
Yeah.
So, you kind of see seems to reduce quite a lot of pressure on that front.
Yeah.
I think it's manageable.
Yeah.
If you look across the corporates, even in the US, right, the larger corporates, the debt level is really, really healthy.
Yeah.
But of course, if you go to commercial property space, certain subsectors, it's tough, and regional banks and everything, it's tough. But I think across the board, balance sheet is actually pretty strong.
Yeah, and do you think we're forgetting, because you talk about Trump and all that sort of stuff, but really the big tailwind for businesses right around the world is artificial intelligence. And even though it may well have been hyped up for some bigger corporations, there's probably a whole range of little companies or significant medium-sized companies that could get enormous benefits from artificial intelligence when they apply it to their business. And this could be a productivity payoff that we can't even calculate now.
Oh, absolutely, absolutely. And it's happening very, very rapidly.
Yeah.
Now that we're hearing every corporate is talking about finding efficiencies, right? Even, from our daily jobs, we see how that can help us to, save time.
Right.
That's the efficiencies we see. And then most of the businesses, so, US businesses already started investing heavily trying to benefit from that. And in Australia, even Australia, majority of companies in the last reporting season already talking about on the board level and on the company level about the investments and then, the project they set up to try and see how they can benefit from it.
Yeah, I guess there will be companies that will miss out. I guess there'll be like new revelations like Appen. Appen in a sense had it to itself until other companies decided to use technology to replace them. That will happen, but there'll be some real beneficiaries to companies and productivity.
That's right. I think there's more benefit than, what everyone fear about what is AI going to do, take away jobs and things. But I think it's the more benefit than and opportunities for companies.
Okay. Now I've for the Switzer report today looked at a number of companies that the analysts really like. And so I'm going to run through them with you to see if you're a thumbs up or thumbs down fund manager on this one. So Zero, the consensus rise was 17%. And 6 out of 6 analysts like it. Can we make it 7 out of 7?
Yeah, absolutely. We like Zero. Zero is a
It's
company.
starting to look like a real good tech company, isn't it?
It is a real good tech company, and it's been not only in Australia, New Zealand's done well, gone to UK, that's done well, now gone to the US, that's looking pretty strong as well. And then this company a few years ago doesn't make profit and only just started making profit, and then that is looking incredibly strong. It's going through that sort of V curve in terms of where the earnings is looking like. So I think this company is a bottom drawer.
Okay. Megaport, consensus 29.7, 6 out of 6 like it. Last week, a lot of people bought Megaport. It seems to me it's probably around near the bottom of what the share price is. But do you think the future is good for a company like Megaport?
Look, longer term, it certainly look like this business has, like great fit in this whole AI revolution. Challenge is the near term. We're not seeing any improvement. If anything, the growth in the new customer has been slowing and slowing, even though they're adding out more salespeople. And I'm surprised actually this many analysts still like it because companies had many earnings downgrades. I do think that if you move past after next 6 months, things potentially look a bit better. If we've seen some of those salespeople they just added improving. I heard the latest one was that one of the analysts actually went and checked all their LinkedIn jobs, and apparently they started hiring more people again. So that could mean that maybe they are seeing the sales is responding to their sales staff. So maybe the earnings might look strong, but normally it's very volatile around quarterly. The investor just got to be a bit careful chasing into the quarterly.
Okay, so that's a question mark. Audinate, 44.9% rise, 4 out of 4 like the company. I see Audinate and Megaport probably in the same boat.
Bucket. Yeah, that's right.
They look potentially very good. Obviously the analysts do like the company. So question mark on that one too?
It's question mark, but I do feel, in a portfolio, you normally have you have a bit of everything, right? You have your defensive, you have your CSLs, you've got some of your resource company, maybe a little bit financial. And then on the edges, you need to have a bit of volatile companies that you can put a bit more risk. And so these are the risky stocks you put into a portfolio, but small portion. But if they do well, they have a good result, share price could be up 30%.
It reminds me of Mesoblast.
That one, yeah. So now
It's
everyone,
come good, but you've had to wait 2 years for it to come good.
I remember this company. I waited 10 years. Yeah, but it's done incredibly well. So, and especially now with this product approval, it's
Yeah,
actually
the
looking
FD.
really promising. Yeah, I think
Okay,
it's
so
interesting.
if you're a person who hung on and maybe you've broken even, would you hang on to Mesoblast?
I would,
Yeah,
because
I
no
would
one
too.
owns Mesoblast.
Yeah.
And then I think people really interested in looking at it now. It's the first ever stem cell approval, I think, in the world, right?
Yeah.
So this is because stem cells hard,
Yeah, yeah.
and I just think that's quite impressive. That's
Yeah.
very impressive.
There's also a collective action against the company as well.
Okay, I haven't really followed
No,
it, but
but
I just thought it was incredible.
okay, yeah, but that was before the FDA approval. Okay,
Okay.
now it's Champion Iron.
Mm,
I like BHP and Rio, and I thought, well, what's another? We know Fortescue is
mm.
obviously another one,
Yeah, yeah.
but the analysts like Champion Iron.
Mm,
CIA, I love its ticker code.
that's right.
Up 21.2, 303, like it. What do you think of Champion Iron?
I think it looks okay. Usually, it's a larger cap. You want iron ore exposure. You
Mm,
go into the Fortescue for lower grade but leverage play, and then you got the BHP and
yeah,
Rio. And then the smaller end, you go to Champion Iron,
yeah,
and it's got production growth, and it's got now right now the iron ore price is looking pretty strong.
yeah,
So I actually do like it. I
yeah.
think iron ore.
Give me a surprise package.
Yeah, it's a price package, and also they all come upgrade. I'm not sure how much upgrade is expected for this one, but mark to market for this SKU is something like 10 to 20%.
Mm,
Because analyst hasn't put the high iron ore price in there yet.
yeah.
They're all generating pretty good cash
Okay.
flow. Yeah.
This is an interesting one. Chalice Mining.
Mm.
Have you got a view on Chalice Mining? Let me give you the numbers. 179.4% upside and 202. So it's only a small company. Not everyone covers it. I know Tim Goyder has a very big shareholding in Chalice Mining, and he's obviously lost he made a lot of money, then he
Yeah,
probably
that's
lost a
right.
lot of money. What do you think of a diversified mining company
Yeah,
like
yeah.
that?
Look, I think it's for the believers, you
Yeah,
really have to follow the believers really like this one.
yeah, they do.
And for me, because I like to play a little bit de-risk, especially in the gold space, right? A little bit de-risk. So I like to play into, your Northern Star.
Yeah.
And mark to market Northern Star actually still come upgrade, right? And
Oh, yeah.
production's okay.
Great company.
Yeah, and then you've got the Genesis.
Mm,
We got the Genesis, and the recently results pretty good. Potentially if you want other gold, the Capricorn looks pretty good.
yeah.
So it's just, yeah, so these ones are a bit easier for me. And Chalice Mining, I think for people who follow the management, they
It's
follow them.
it's
Yeah, yeah.
another one of those speculators. You throw it in
Yeah.
the bottom drawer, and one day you might say, "You little beauty," but at
Yeah,
this
that's right.
point in
Have small
time,
position, not big
that's right.
positions.
That's
Yeah,
right.
that's right.
That's CSL. It's let us down for at least 2 years. I like the company. All the analysts, 22% upside, 6 out of 6 say yes. What are you saying?
I'm at the moment probably a bit more neutral, the CSL. I like it. Long term,
You used
it's
to
important.
love it,
No,
and
look,
now
I
you
see.
like it.
Yeah, look, I like it. I think at the moment there's a couple of issues. So one of the investment or the investment, the V4 business that they bought hasn't really, shoot the lights out and let everyone they're really excited about it. And the recovery out of the COVID has been taken longer.
Yeah.
And now heading into Trump administration, there's a bit of fear about drug pricing. So that's what happened
Yeah,
previously.
that's true.
Drug pricing, not sure it's directly impacted, and also remember they get a lot of the blood collection along that Mexico border.
Ah,
And
yeah.
then a lot of Mexican people, they go across the border to donate the blood, sell the blood and
Yeah.
then go back
Yeah.
out. So Trump administration last time made it very difficult.
Mm.
So that might create a bit of shortage.
Yeah.
We don't know because it's quite a big supply to the industry, not just them, there's an
No,
industry.
no.
So yeah, so there's a bit of things a bit unsure. It's more in the neutral. Do I go out and buy it? I think it will go higher in 12 months. But if the market against a strong market, maybe it's not going to go up as much.
Okay, here's one you might not know, but you seem to
I
know
do. I
it.
like this one.
Yeah, Neuron
Yeah.
Pharmaceuticals. And now, a lot of the people, our subscribers to the Switch Report, asked us about this about 4 or 5 months ago, and it kept rising. And then I was offered the chance to interview the CEO in November, and I was so busy, didn't get him. It spiked unbelievably in December, and now it's come back down again.
Yeah, it did.
Well, what's your view, the analyst view on Neuron Pharmaceuticals? Up 108%, 202 say, yes, we like it.
I like it. And I think I feel like I need to do a bit more work in this one. Share price has come off a lot.
Yeah.
12 months ago or 1.5 years ago, they first commercialized their first product.
Yeah.
And that product, and commercializing was great. They're doing it with one of their partner over in the US. But the thing is, analysts put such big expectations in.
Yeah.
And then they had a couple of side effects. So people who get on this drug, I think gets a bit diarrhea, like gets a bit sick. So they sort of get off a bit and then they work out, oh, okay, you can't have a too strong doses initially, just take a bit longer. So a bit of hiccup like that. So reduced people's expectation a lot.
Yeah.
So it just hiccup right initially. So, and then so in the last year and a half, we're just constantly seeing the downgrade for expectations of that drug. Now, this drug, whatever they sell, they get a huge profit margin because it's already approved. So it's actually fantastic. Now, current share price is reflecting what the royalty they'll get from this particular drug without any upside. So it's actually not paying much, and that's guaranteed coming through. They have one more drug come. They actually have more in development, and the next one is based on very similar sort of technology. I think they just started recruiting for for a trial now, and should get quick approval, and that's not priced at
So
all.
you seem to be saying to me this is an interesting speculative
interesting.
company that has a fair bit of substance about it.
And it's already self-funding, so it's generating cash already. They're not, if they don't do the trial, they don't spend any money, so it's cash box almost.
Okay. Tyro,
Yeah.
63% upside. 4 out of 5 say yes. Some people have even bigger than 62%. What do you say?
Look, I like Tyro.
So
I think, I like Tyro. I think in that whole payments in this space, right, in Australia, they're going through a bit of challenging period just because of the regulation, what you can charge, what fee you can charge, and with a lot of those, it's creating a bit of uncertainty. And whereas compared to payment company offshore, like you look at the block, the zip, and it's going nuts. And so those ones going really well. I think in that whole payment space now, there's a new one called just
Square.
CCL is the code. And actually, I've just forgot the name of it. It listed last year, and essentially it does a lot of volume for those regional banks. It actually was owned by the group of regional banks previously, and then they just sold parts of their holding. And so this company is actually growing quite fast, and it's linked to the volume of the digital.
So you think it's a bit of a rival to Tyro?
That might be interesting. Yeah, not direct comparable, but it's that one's quite interesting, and it's not expensive either.
Okay. IDP, IEL, the IDP education. And believe it or not, the analysts still like it. 4 out of 4 say yes, 39.1% upside. We know that regulations have changed and haven't helped this business. What do you reckon?
I like this business as well. The challenge is that this earnings update, potentially there's a double-digit earnings downside. People haven't updated their numbers. I think that's it. So
you think more bad news, and would you buy it after that bad news?
I will. Yeah, I will.
Okay, you heard it here first. And one final one, Paladin. Are you a nuclear gambler?
Look, I think in my energy complex, I always have a little bit of a nuclear. I just think it forms.
But you're a boss energy girl.
Yeah, boss energy. And so kind of they're all done, very volatile, be incredibly volatile. So, got a bit of energy. And with nuclear, I think at some point, they serve as a purpose. And then these guys, early in productions, and these guys actually got really good.
And it seems to me in 5 years' time, I think nearly everyone will be using nuclear because it is seen as a positive for the environment and whatever. At this point in time, it's still pretty political, but I think 5 years down the track, we'll
at the moment, it's interesting. I think over the weekend, I was seeing that some of the larger asset managers backed out of 2050 commitment. I don't know if it's BlackRock, I think, stepped out. Then JP Morgan said they're not going to commit. So Macquarie hasn't commented. So these policy, I think just these long-term policy eventually will get there. But it just meanwhile, there's sometimes a bit short-term, we're looking at what our needs are, a bit of shortage, we'll look at this.
I think if there wasn't going to be a President Donald Trump, those companies would not be backing out
absolutely.
the commitment.
Absolutely. It's a bit like the technology company backing out of the monitorings and things.
Okay, I've gone through the companies that, F in Arena says have plenty of upside. What's your favorite company for 2025 that maybe you're buying now or you bought recently? What's the latest addition to the?
I would say, the latest addition I haven't previously talked about is actually Premier.
Yeah.
I think that
Bring
company is,
investments.
yeah,
Solomon
absolutely.
Lou would like you
Yeah,
supporting
I
his
think it's
company.
fantastic. Yeah, so I actually think that yes, trading is a bit soft
Yeah.
and the like, it's a bit disappointing. But I think, first of all, it's a Premier Investment has a whole list of different companies in there.
Yeah.
Breville, have you seen the share price? It's gone completely brushed off the
He
freight.
hasn't got Breville, has it?
He still has Breville, Breville
Premier.
steak. Yeah.
Oh, does he? A
Yeah,
steak.
steak. No,
Yeah,
no,
oh,
Breville.
yeah.
He's got Breville steak.
Yeah,
So,
major
so that's the thing
shareholder.
about
Okay,
yeah.
yeah.
So it's actually, so
Yeah.
he's still got that. And then he's got, the Smeagol, the other fast growing, the Peter
Peter
Alexander,
Alexander.
yeah,
Yeah.
and all global rollout.
Yeah.
The company is trading on something like 13 times
Yeah.
for a global rollout story. La Visa's much more expensive
Yeah.
on global rollout. So, I just think it looks good. Yes, retail apparel is a little bit tough. They're going through this transaction.
But rate cuts lie ahead, and that should be good for retail.
Yeah, exactly. And then rate cut comes through, it's very, very leveraged. So I just think it's very undervalued. And I like to follow great managers who execute, right? And Solomon Lou, he has always been a fantastic retailer.
Yeah.
He'll look through the cycle. Whereas we're equity investor, we can be very short term and go, oh, earnings upgrade and downgrade. I think that you've got to look through this one. You've got to buy this one.
Okay. That's Junbei Liu of Tribeca Alpha Plus. And that was Junbei Liu of Tribeca Alpha Plus. And coming up is Richard Quinn of Bentham Asset Management. Well, joining me now is Richard Quinn, the MD of Bentham Asset Management, in a year which is expected to be pretty good for bonds. Thanks for joining us, Richard.
Thanks, Peter. It's a pleasure to join you on your show.
Okay. So tell us about Bentham Asset Management. What's it specialise in and what's its competitive advantage, you think?
Yeah, listen, we specialise in global fixed interest and credit, and we've been doing it for a long time, about 20, 25 years. We spun out of Credit Suisse 15 years ago, and as a boutique, we spun out with about $1 billion, and now we're managing around $10 billion, and mainly in the credit and fixed income area. So we don't see the two as essentially different.
Which I think a lot of normal people do as well, though the industry likes to differentiate it. If you had to differentiate it, how would you do it?
The way I would do it by the amount of credit risk or rating risk that you're taking. So how much default risk are you taking? And fortunately, the market's evolved to such an extent we can tell how much credit risk is taken by all those handles that we have from rating agencies. So it's very much a traded market in our world anyway.
Yeah. And I guess what I often say that when you're involved in credit, it is a riskier play than putting money in a bond fund that largely is going to government bonds and really good quality corporate bonds. Is that a fair call?
Yeah, I think it's a fair call. Like we will invest up and down the cap stack and in government bonds as well as high yield bonds and leverage loans. But yeah, most definitely. I look at the semi-government bonds right now. I quite like them. I think they're quite attractive, but they're not likely to have default risk that you're going to have in high yield bonds or leverage loans.
For the sake of our viewers, a semi-government bond, what's a well-known one that you might refer to?
Oh, listen, you could have a New South Wales T Corp bond that's probably yielding 90 basis points over the government bonds right now, which is probably about, so you're getting almost paid 1% to invest in a government bond that's not quite a Commonwealth government bond, but you know what? New South Wales isn't so bad.
Yeah, that's right. Be different if you're maybe investing in a state in South America, but largely we could trust the states of
100%.
Australia. They
Well,
are carrying a bit of debt at the moment. They still can tax us if they need to.
Well, I think they're giving everyone a little bit of pain, especially in Victoria right now. But it's not like lending money to Argentina. These are very, but having said that, if you go back in history, New South Wales, when building that bridge behind you, It came very close to defaulting on a few things. So, history does change things, right?
Yeah, exactly right. All right. So why are the experts saying that this should be a good year for bonds?
Yeah, listen, I think the real reason that it'll be a good year for bonds is yields are higher. So if you're looking at the yield level, if you're yielding above cash, uh, Australian bonds were yielding as low as 0.62%, the whole market, if you go back into COVID. And now, you've got a good 4.5 handle, if not more. And if you want to lock in that high cash rate, that's what fixed interest is for. But if you think interest rates are going to continue to go up, then maybe a floating rate asset is a better one, that one that pays the cash rate plus. But a fixed rate, if we do see the RBA cut, and we do think they will cut, that means locking in this higher fixed rate is good for the investor, especially for the retiree, I think.
Yeah. So what you're saying is that because bond fund managers have had the joy of much better interest rates than we saw during COVID, which were ridiculously low, in a sense that if interest rates do fall over the next year or two, the investments that they're making now will look more valuable because they won't be getting 4 or 5% in 2 or 3 years' time. They might be having to accept 3 or 4%.
Correct. And that's the thing, like the change in interest rates, if interest rates were to come down, and I know a lot of retirees would have been quite annoyed with the very low interest rates. Well, you can avoid that by fixing in at this level right now. And if you compare the yield on interest rates and bonds relative to equities right now, they're quite comparable, which is unusual. So it is good value relative to other assets. And probably that's the other side of what we're talking about. Like the valuation is better, but the comparative valuation or the relative value looks quite good right now.
Okay, let me ask this question, and I'm sure you haven't been asked this question recently, but if Donald Trump didn't win the election, would the likelihood have been that would even be a better year for bonds?
Probably a better year for bonds, but I think be very careful. I think everyone's presumptive on how badly President Trump might behave, and I think that's he may actually perform a lot better than people expect. And I know that we try not to get caught up in the politics of things. We're very much market people, and I do think he set a very low bar for maintaining the norm, and I think he'll do better than that. I think he'll do a lot better than people think. But would it have been better for bonds generally? Yes. Yeah. But we haven't talked about credit markets. So credit spreads have contracted already. So it's been better. It's probably been worse for bonds, but better for credit. And that's also likewise it's been better for equities than people would have expected, I think.
Okay, well, I don't like to call myself an expert on bonds. That's why I'm talking to you. But my thinking is this, and you correct me if I'm wrong. Right. Before Donald Trump won the election, we were talking about a Goldilocks recovery in the US. Namely, we were talking no recession, but probably, 5 interest rate cuts in 2022. But since the Trumpalocks recovery's come along, which I call, we're now looking at possibly only 2 interest rate cuts. Would bonds have done better if interest rates did actually come down by five cuts rather than 2?
Of course they would. But what's actually happened, which is unusual, the rest of the world has sold off. Yeah. Now, the rest of the world is not, I don't think, even though people complain about the fiscal responsibility all around the world, a lot of countries are being managed a lot more responsibly, and their economies are in much more dire straits. Like I would put New Zealand, UK, Germany, France, even Australia in those categories. We're not as robust as they are, partly because a lot of people in the US have got mortgages fixed at 2%. We just don't have the joy of that. So we're, I think those countries and economies are sweating a little bit. And so while they seem to have followed the interest rates up, they probably shouldn't be as high interest rate. And we've got a terminal cash rate in the US at 4 now, and a 4 in probably a couple of these other countries as well. I just don't think that works in those other countries because it's been such a big move. And also there's a big shock still to be felt from the lagged effect of rising interest rates. Remember, as we said earlier, there's been a 4% increase in interest rates across the board. Everyone has to get used to running with that higher interest rate. It's funny that we're focusing in on governments and how much they can borrow, but corporates can borrow a lot less as well because the interest rate cost is so much higher.
Yeah. You mentioned earlier that you do think the RBA will cut. Do you think February's a chance?
Yeah, I think February's a chance. I'd like to say the RBA is completely independent of government, but I think they're part of the government or part of the public service. And I'm sure there's many phone calls pointing out the weaker parts of the economy. And I do think it's time. I do think it's time. There are some signs of pressure. Now, probably one thing to bear in mind with that, though, the labour force numbers have been pretty good. And so we have had a growing market. Our unemployment rate's risen a little bit to 4%. Like we would have dreamed of a 4% unemployment rate, 20 years ago would have been a dream. And I think we said the non-inflationary unemployment rate was 5%, right? So, the unemployment rate's doing well, but I think generally governments have had to slow their spending and corporates the same. So I think it's time for do something.
Yeah. And in many ways, the numbers do look good because of something you referred to earlier. Think of all the people who are getting jobs in Victoria because the Victorian government has been spending a lot of money. And the Queensland and New South Wales, they've all been spending a lot of money, while the corporate sector clearly is pulling back. And I do think that 80,000 odd part-time jobs last week was probably a pointer to something's going on in the labour market, which is not great.
I think, and also that's what we've seen in New Zealand as well, right? So the New Zealand government spent a lot and raised a lot of public service jobs, and the new government has come in and got rid of a lot of those jobs. I think we're seeing the same thing here, and maybe we'll see the same reaction here. It's surprising to me that the Liberal government has a chance to get in now, but they're even copying the election phrases that they had in New Zealand. So,
okay, let me put you on the spot, mate. If one of our viewers is looking for a kind of a 5% return, and maybe better than 5%, but at least 5, which one of your offerings would be the best for that kind of risk averse, but still hopeful 5%? Yeah,
I think we've got a defensive income fund that would do that easily, and if you see the sell-off in the share market, you get a really good return from that fund. It would get a higher return. I think that's the thing. We're going to go back into that world of negative correlation with bonds and equities. While interest rates are rising, bonds have been underperforming, but there's been a long period of underperformance. So I think those more defensive funds will do well. And then eventually, when credit reprices, because credit spreads are the tightest we've seen since 2006.
Yeah.
That's very tight. There's been a lot of money thrown at credit. And unfortunately, I think, we normally see tight credit spreads are followed by mistakes. So that's normally what happens.
Okay. Does that create opportunities for you, or does it create risks?
Love it. We love it. Like we actually invested quite a lot in credit and riskier credit during COVID. Once we understood what was going on, it was easy to invest. But now we're just not being rewarded for the risk, so we're not taking as much.
Richard, one last question. I can't help go back to the time when Greece was in a lot of trouble. And how high were Greek government bonds then? They were ridiculously high.
And you know what? They're now tighter than French bonds, right?
Yeah.
They got
They
nuts.
actually were a good buy if you had the guts to do it.
Well, yeah, like the weekend they were talking about nationalizing deposits, right? So I remember the weekend, we had hedges on and we had to take the hedges off really quickly because as soon as they insured or made sure that the average depositor was going to be looked after, they started to restructure. Like there's been a lot of restructuring in the banking sector globally. I don't think we're going to have a 2008 event anytime soon, but there may be a different event.
Yeah.
So but where that comes from, if I knew where the problems were going to be before they happened, it would be great. We have shortened, we have got put shorts on some emerging market bonds and some high yield bonds, but not big ones. It's just, it's not worth it.
One last question. This might be regarded as a cheeky question, but as someone who's a great fan of the stock market, we're often told that you really smart bond guys have much better predictive powers because of your yield curve. If it's inverted, we have to worry about a recession. There's been a few mistakes on those recession calls, haven't they, in recent?
Yeah. Listen, you know what? I think generally speaking, bond people tend to be more quantitative. We do look at things and we look at the numbers probably a little bit more intently, and we don't have to look at the promise of growth. And right now, I think there's a big promise of growth in the equity market. We just look at cash flows, and the cash flows are what look good to us. Risk premium wise, I think bonds look a little bit better. Credit, like equities, I've got to say, to a certain extent, looks a bit fully priced, which means we're paying up for the risk. And usually when you overpay for risk, you probably don't get the same sort of return.
Yeah, good point. Very, very safe answer there, Richard. I'm impressed with that. You could have bagged the stockbrokers a lot harder than you did then.
No, I don't. Again, it's really hard to bag the stock market. It's done so well, and especially the Australian stock market. With its franking credits and the like, it has a lot better. Like I do think eventually we're going to be looking at some tax reform, and we've seen a little bit. I wouldn't call it reform right now, just call it tax.
It's tax reform talk. That's about at this stage. Mate, thanks for joining us.
Appreciate your time, and best of luck to all your investors.
Fantastic. That's Richard Quinn, MD of Bentham Asset Management. And that was Richard Quinn of Bentham Asset Management. Thanks for joining us for the show. If you want to get more information, more analysis, more inside analysis of great companies, think about becoming a subscriber to the Switzer Report. Go to switzerreport.com.au and see how you can become a member. We put out 3 newsletters a week. We do a program called Boom, Doom, Zoom on Thursday. It's a half-hour webinar where you can actually ring in or text in your questions about stocks. And Paul Rickard and myself and a host of other star experts come on the program to help answer the questions around stocks. So once again, that's our show. Thanks for joining us. See you next week.